Welcome to the Real Estate Guys radio program. Lots of ways to invest in real estate, lots of styles of real estate investing. We're going to talk today about the basic real estate investment, the single-family house. It's not what it always was. Things are changing, and a lot of great news. We're at an amazing conference. We're going to share a lot of guests with you today and a lot of great thoughts today on the Real Estate Guys radio program. All aboard! Registration is now open for the Real Estate Guys 14th Annual Investor Summit at Sea. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, international developer Beth Clifford, attorneys Mauricio Raoul and Jeffrey Verdon, and the author of The Creature from Jekyll Island, G. Edward Griffin. New for this year, commercial mortgage broker and syndicator Michael Becker, personal development icon Kyle Wilson, and Ken McElroy's partner Ross McAllister. And joining us live and in person for his third Investor Summit, Robert Kiyosaki. It all begins February 26, 2016 in Miami, Florida. Visit realestateguysradio.com and click the tab that says Summit to learn more and reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 14th Annual Investor Summit at Sea. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms, from Phoenix, Arizona this week. Let's say hello to co-host financial strategist Russell Gray.
Hey, Robert.
We're at the 4th Annual Single Family Rental Investment Conference put on by IMN. This is a group that we've been to some conferences of over the years. They do a bunch of great events in a whole bunch of different areas. About half of what they do is in real estate, and then they do continuing education for attorneys and all kinds of different great stuff. But very, very interesting event. And it's single-family based. We're talking about single-family assets, but 80% of the room are in suits and ties.
Yeah, well, I mean, I think obviously the 4th annual, right? Single-family homes have been around for a very, very, very long time.
Longer than 4 years.
This is the 4th annual. You know, what you see, the first thing you recognize, you talk about the suits and ties, but you just recognize there's been a major shift in the single-family home market. And we've watched it happen, right? We went to the meltdown. There was a lot of mom-and-pop investors in the space in the run-up. It was the hot commodity. Everybody and their brother and their mother and their sister was out there buying single-family homes, bidding it up to whatever, holding it, hoping that they could sell it a year later for $50,000 or $100,000 more. Of course, we all know what happened. Well, in the wake of that, the prices dropped. It was a huge correction, to use a Wall Street term. And then a guy named Warren Buffett came out and goes, hey, you know what? If I could go buy 200,000 family homes right now, I would. The problem is it's not a well-organized industry. It's a mom-and-pop industry. Little by little, companies like Blackstone and big hedge funds aggregated capital. They went out there and painstakingly, property at a time, but they were able to buy also groups of properties out of distress foreclosure from banks and buying what they call tapes, and then they get rid of the garbage, they clean up the other stuff, and then they get it tenanted and they hold it for the production of income until some future date and time. Around this has evolved this entire industry now that is creating software products and analytical products and all kinds of ancillary services, so that portfolio manager who's sitting there on 1,000 properties or 2,000 properties, or in some cases 10 and 20,000 single-family properties, has a whole host of services that didn't exist. And now a conference that is not completely dedicated to that, because there's a lot of mom-and-pop investors here too, but there's a lot of people here, that industries that did not even exist 10 years ago, to service this particular niche. And of course, with the big decline in home ownership in the United States and the big increase in rental, not just the number of renters, but the price that people are willing to pay to rent, it has really attracted a lot of attention. So it's an interesting place to be, 4 years into the conference, especially talking to the people who've been here for a little while that are saying, hey, this is what I've seen the changes. Of course, for us, it's just a point on the curve, but a lot of interesting things here. Yeah,
so we're going to meet many of the folks that were speakers and attendees, a lot of listeners that we've been able to say hello to here. So it's going to be a great show. You're going to learn a lot, I'm sure. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Hi, I'm Mark Victor Hans. You're listening to The Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. We are in Phoenix, Arizona, talking single-family houses. And let's say hello to a gentleman who chaired the first event yesterday, Mr. Dennis Cisterna. And Dennis, you were the first guy out of the gate yesterday. You had a great panel, and you were talking about kind of the big picture of where we are in the single-family world. Give us the high notes.
Sure. So we like to start off this event by really covering what's going on in the macroeconomy, how that impacts the housing markets, and more particularly, how that impacts the single-family rental industry.
Yep.
We cover a lot of the basic topics, GDP growth, employment growth, unemployment, the unemployment rate. And there's a lot of different factors going on right now that are contributing to a greater opportunity within the single-family rental industry. So I think if you talk to most people on the street or you read any of the conventional wisdom about the economy, it still feels spongy. People don't think we're doing bad, but they certainly don't think we're doing good yet.
Right.
And one of the reasons for that is really that the housing market, although people think it has recovered, there's really a lot of fragmentation and misinformation in the market right now. So, for example, housing starts, building permit issuance is down 75% from the highs of the pre-recession,
right,
and about half of what they are historically. And if you think about it, the population of the U.S. is much larger now than it was in 1960.
And increasing.
And increasing every year, and yet we're only issuing 500,000 permits. You also have had you haven't had a real recovery in the owner-occupied mortgage market. So even though the population is growing and there's a need for a larger housing stock, we're not building more homes. And most of these people can't afford or qualify to get a mortgage. So you're seeing some stagnation when it comes to existing home sales and new home sales. And when you look at the price appreciation, a lot of it has been fueled by investor demand more than traditional demand from a consumer. As it relates to the single-family industry, it's not a new market. I know a lot of people will read in Bloomberg or the Wall Street Journal that Wall Street is taking over Main Street.
Right.
It's a great headline. There are 15 million single-family homes in this country that are rented out right now.
Okay.
Less than 200,000 of them are owned by institutional Wall Street firms. 1.3% of the market.
One of the most amazing slides you showed was the number of people who just own a single house are by far the majority owners.
That's right. One owner, one property, one rental property is 48% of the market.
Right.
And that's 11 million different people that own one rental property.
Yeah.
A lot of that has been financed historically by Fannie Mae, Freddie Mac kind of investor loans, 1 to 4 units. What's also interesting about this is because your audience doesn't do just single-family houses, the larger market considers Plex product, duplex, triplex, condo, townhome, all that. And when you're looking at that, the market's actually 22 million homes.
Wow.
So it's even bigger. And it is all related to the same. It's taking advantage of a decline in home ownership in the United States, which has steadily gone down since the recession hit. And because of a number of different forces, most economists project it's going to continue to slide down. So you look at it, it's kind of a perfect storm for people that want to invest in renters because you have a surging amount of demand. You have increased rental rates. You have a consumer base that can't buy a home right now. The personal savings rate in this country is declining. So it's making it harder and harder for people to even come up with the 3% they need for an agency-backed loan, never mind 20% if they're going to get a jumbo loan or non-conforming loan. So it's made a real struggle for people to increase that home ownership rate. And as a result, you've seen not only a tremendous amount of demand for rental housing, but some really incredible yields for folks that are investing in the space. And what used to be the norm was, okay, I'd get a Fannie or a Freddie loan, and I could buy up to the number of properties that my personal income allows.
Right.
One of the real big benefits of the big Wall Street firms coming in is they shook up the capital markets here, where banks and private equity groups started saying, well, I'll lend on those kind of homes. This seems like a safe bet.
Yeah.
We expect housing to continue to appreciate. We expect there to be demand. This feels like a safe asset class to lend on. So starting in 2011 and 12, you had companies that started entering the space as lenders. So instead of you, the smaller investor, being constrained by your personal income, you're a dentist, great. If you're a school teacher, you're never getting past one investment property, right. Hence the 11 million people.
Yeah.
But as these lenders entered the market, it let you stretch your dollar further. It also, because the debt was reasonably priced, these aren't hard money loans that people are providing. These are more term loans, 5, 10, even 30-year fixed rate loans that are generally priced more affordably than what the yield is on the property. So the debt is accretive. So not only is it letting you stretch your dollar further, but you're able to get higher leverage profits on top of that. So instead of buying one property with your $100,000, you're buying 3 or 4 properties, and instead of making a cash on cash return of 11%, you're making 17%. I'm sure a lot of your listeners look at all types of different asset classes and different investment objectives. 17% anywhere you're going is pretty darn good, and that doesn't even factor in the potential appreciation for housing, right? I mean, if you look at where home prices are right now, we've kind of righted the ship where pricing right now is kind of where it should have been if it's been at its historical appreciation rate of 3% or so. But there's still a lot of markets that are undervalued, and there is some feeling that eventually the mortgage markets will begin to thaw. And what a great treat that is for someone that's owning an income property that's appreciated over time. If they need some additional liquidity, they can sell part of their portfolio. It's really just a very dynamic market right now. It's not really different than what happened speaking of other asset classes, self-storage, multifamily, just normal big apartments. In the 1960s, the numbers weren't that dissimilar. There was, one owner, one apartment complex, that's it. And it wasn't until REITs started being formed and people started aggregating, we started to see the scale. And the good news is this industry is taking off a lot of the efficiencies that those sectors have already created. So you're seeing the maturity of this market happen at a pace I haven't seen with any other asset class. But because of the sheer size of it, 22 million units, there is opportunity out there, whether you live in California or Texas or Florida or New York. You just have to be diligent about what you're doing, as you should with any kind of investment.
And whether you're interested in acquiring 200 or 300 houses or just a couple of houses.
That's right. And it's been really interesting for me at First Key Lending. We're one of the specialty finance companies in this space that we were created to help the smaller and middle market investors grow. I'm never going to have one of these publicly traded companies come to me because they can go directly to Wall Street and get their own bonds issued.
Sure.
But a guy comes to us with 5 properties and he wants to own 50. Great. We're going to provide him the leverage to increase his liquidity, keep buying more houses. There's other lenders that do that same thing, and it's really interesting. We've only been around for about 3 years. We've done a little over $1 billion worth of loans over that time, and the smallest loan we've done is one property, $75,000, and the biggest loan we've done is an acquisition line for over $100 million. And it's really interesting when you have a good operator, a good investor, once you unlock the power of debt, and again, reasonably priced debt with good terms, it's amazing how quickly they're able to scale their company. And I think if you took a survey of, these big Wall Street guys, these guys must be the most efficient operators of all. They have the scalability.
Right.
There should be economies of scale, but I could bring out a parade of mid-sized investors that own between 50 and 500 homes, and they blow those yields to the roof.
Yeah. Well, that's one of the recurring themes here, right? We're seeing these mid-level guys. I mean, there were folks who have 3,000 houses, 200 houses, all over the map. A lot of folks looking to get more, right? That's a big theme here. You see a lot more acquisition than you see divestiture, it seems right now. But the person that you deal with on a lending basis is a pretty wide range. I mean, it's not just any one type of an investor, and so financing is critical for single-family homes. We heard folks on various panels who are putting together portfolios for cash, but our typical investor listener is probably somebody who wants to use leverage. And the way that loans have changed over the last several years has been crazy. I mean, there's so many changes, regulations, and so forth. What do you see? Is there going to be more availability of financing? A lot on your panel there was to talk about but nobody can qualify. What's that look like?
So those are really two different types of lending, right? Getting a owner-occupied mortgage for the house you want to live in, that's consumer financing, and that is the most regulated industry you could think about.
Yes.
I don't do that personally. First Key doesn't originate those.
That explains why you still have hair.
Right. So that industry is a tough nut to crack. And if you look at a lot of what's going on in that industry, it's ripe for disruption. And you've probably read a decent amount about these venture capital, online crowdfunding kind of places where you apply in 15 minutes and you get your loan. And,
right.
Well, getting any kind of consumer loan and following all the rules, there are not loans like that take 15 minutes. But that being said, what they do is they look at the qualifying metrics of a borrower much different. So whereas if you are going through a traditional mortgage for a home you want to buy, they're looking at your income, your taxes for the last couple of years, they're looking at your credit score, and it doesn't matter if you had one blip on your radar. The recession damaged the credit score for millions upon millions of people, but there are a great percentage of those people that have then rectified. They haven't missed a payment on anything since then. They just, the economy collapsed. There's not much you can do. So why take these people out of the ball game? So some of these new lenders in the space are saying, well, wait a minute, this guy's got a good job. He makes a lot of money. He can afford this mortgage. He's paying this much in rent, if not more already.
Right.
Why not give this guy a reasonably priced loan? And that's happening in the market right now. I think it'll continue to happen. With that side of the space, you're going to need the old guards of traditional mortgage finance to kind of pick up on the technology slant and pick up on a new way of underwriting their borrowers. The tried and true method obviously didn't work before because everything still exploded anyway.
Yep.
And then when it comes to really these investor loans, these are business purpose loans, right? So they're not subject to the same amount of regulation that a traditional mortgage for an owner-occupied unit would be. They are, and what the big difference is, if any of your listeners before have done a Fannie or Freddie investor loan, it's really all about the income of you as the borrower, not anything about the property.
No.
Which it's silly when you're buying an income-producing property to not consider that. So one of the things that First Key has done, whether you're a borrower of one property or 1,000 properties, we're looking at the income on the property level. Yeah. Of course, we want you to be a respectable, solvent, smart business person, but we don't expect everyone to be a multimillionaire that wants to borrow, to expand their real estate portfolio. Because we're looking at the income of the property, that goes back to, well, you need to become an efficient operator. And what's great about this market is because it's so fragmented right now, the yields are there. There's the benefit of the technological advances in property management and rent collection. 10 years ago, there was only one way to collect rent, and that was by banging on the guy's door for a check if he didn't pay. Now, one of the big advancements that you've seen on the multifamily sector that certain operators are using on the single-family side is, well, we're going to do ACH debit and automatic payment with our tenants. A, it's less work for them. B, it reduces our collection loss tremendously. And this is all about affecting the bottom line, right? So even if you buy something at the right price, you want to make your yields even better by being a better operator. And there are so many tools available to the average investor that weren't there just 2 or 3 years ago. This industry is piggybacking off all the work the multifamily sector has done. It's piggybacking on all the work the big Wall Street guys have done when they came into play. And it's basically, rolling downhill for all the individual investors where they're getting the benefit of technology, capital markets. It's really interesting what's going on in this sector right now. And as I myself am an investor as well, right? Even though I do these loans, I've studied the housing markets for 15 years, and I haven't really seen this kind of an opportunity for investors, big or small. And I think those don't come along very often.
Right.
If you had a ton of capital when the recession came, yes, you could have made a ton of money. But if you were like most people, you were scrapping together and you didn't know what to do. Now, with the advent of attractive financing and the fact that you've had appreciations in certain markets and still more room to grow, as well as increasing rents, that's another great thing about it. Because there's so much demand for rental properties, it keeps pushing rents up in a lot of different markets. So it's really an attractive space right now, and we're still in the second inning of it.
Yeah. All right, good stuff. Well, hey, I know we're going to have folks that are interested in finding out how they can get a hold of you guys and learn more about your loan programs. What's the easiest way to do that, Dennis?
So easiest way is to visit our website, which is firstkeylending.com, FIRSTKEY lending.com.
All right, good stuff. Well, thanks for your time and a great contribution to the conference.
Thanks so much. Appreciate it.
You're tuned to the Real Estate Guys radio program. More when we come back from Phoenix, Arizona. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hi, this is Steve Forbes. You're listening to The Real Estate Guys. Have fun. You'll learn something.
Welcome back to the show. I'm your host, Robert Helms. We're talking single-family investment, and very happy to have Doug Cochran with us from Patch of Land. How are you, sir?
I'm doing well. Thanks for having me on, Robert.
Absolutely. So let's talk about what you guys do. We've spent some time in the last couple of weeks talking about crowdfunding, and in fact, you are hot and heavy into that. So tell us about Patch of Land.
Sure. We are a real estate crowdfunding company that deals strictly with debt. There's other companies out there that work in equity. We're strictly a debt lender.
Yep.
We're nationwide. We work with developers around the country, anything from single-family homes, multifamily homes, hotels, all sorts of asset classes in the commercial range as well.
Awesome. So this is fascinating because a lot of the portals out there are all about a deal that gets split into pieces and investors can invest in it. What you guys do is pretty unique, though. You provide funding to a developer, to a syndicator to put together a deal, and then you go out and piecemeal out the debt. Is that a way to explain it?
Yeah, that's a way to explain it. What we do, the elevator speech, is we originate the loans, we underwrite them in-house, and then we pre-fund the deal, meaning that we bring our own money into the deal.
Yep.
So we can get to the closing table quickly, and so our borrowers can get on with their projects. Then what we do is we open it up to the crowd. And we put it up on our site. We give it a full property profile, the borrower profile. We're very transparent. We put up everything on the site so that our investors, our accredited investors, who are our crowd, they come in and they can read about the project and see if that's something that they want to add into their portfolio. So it's fractionalized.
Yep.
We have anything from one guy might take out the whole deal, or we might have 20 or 30 people who put in smaller pieces.
And, of course, you've already done all the underwriting, so you have the reports, disclosures, information about the property, and
Exactly.
I would also imagine the sponsor.
Exactly. And what we do, and part of the pre-funding that's a benefit to both our borrowers and our investors, is we're willing to put our own money into the deal. So even if our crowd decides not to fill up the deal, we're still confident of the project. We've done our underwriting and our due diligence, and we believe in the property and the sponsor, that we're willing to keep our own money into the deal as well.
So let's talk about there's kind of two angles of this. One is I'm a accredited investor. I want to put money at work. You guys have vetted deals. I like to be on the lending side. I could diversify by product type and market by investing in several deals. So what does it look like from that investor's perspective? How do they sign up for the site? What is it that they do? What are the minimums and range of investment and that kind of stuff?
Yeah, so our minimum per deal is $5,000.
Okay.
Typical loan size, we have a minimum loan amount that we do is $100,000.
Okay.
We go up to about $10 million. I think our biggest deal so far has been about $3.2 million on a hotel.
Okay.
To get involved, I encourage everybody to go to the site, patchofland.com. Sign up as an investor if you're an investor, and fill out some forms. Somebody from our IR team will contact them and bring you through the process. We ensure that everybody is accredited before they can invest in a project.
Right.
And then if you're a borrower, the same thing. You go to our site. You fill out a simple form. A loan officer will contact you and get you through the process and get you to the closing table as quickly as possible.
Well, one of the what some of the critics say about crowdfunding is a lot of the deals don't happen. In this case, the deal has happened. You guys have already funded it, so it's not a matter of, well, I'd pledge $5,000 or $100,000 if the loan happens. It's already happened. So it's, I guess, by the time that they see it on your site, it's a done deal.
It's a done deal, and the minute that they invest in the project, their money's working right away. We pay out dividends every month. They're based off of borrower payment dependent notes, and so the second that you're investing, your money's at work.
Can people invest with their IRAs?
Yes.
Okay, that's pretty common today that people with self-directed IRAs are looking for this kind of investment.
Exactly.
So let's talk about the timeline. What's typical underwriting look like on the developer side? I come to you with a project, I'm looking for funding. What's that time period like?
Well, on the residential side of things, 1 to 4s, we can typically close a loan within 2 weeks. We move pretty quickly. We've done it in 5 days. That's just moving
That's really quickly.
Moving boulders.
Yeah.
And honestly, for our developers, the guys who are really organized and are professional, those are the ones that we can get done very quickly. They know what they're doing, and it's a pretty simple process.
How does the loan compare on a competitive basis with some other loan they might get from a local bank or a lender?
It's very competitive. We're a nationwide lender, and we stay competitive within regions. Different regions have different, pricing scales, and loans are priced based on the inherent risks, LTVs, and experience, and where it's located. Is it judicial, non-judicial? We have a whole proprietary scoring model when we're pricing out loans that take into account all these different data points. So we're very competitive in that respect. And for our borrowers are guys who are getting great deals. And part of getting a great deal is being able to move quickly. And that's part of our biggest benefit is, like I said, we were able to close a deal in 5 days. Which was pretty impressive and got us a borrower for life, I think.
I think so. Wow, that's awesome.
On our commercial deals, we typically can close those out in about 3 to 4 weeks. They take a little longer, it's a little more intense.
And what kind of loan-to-values?
Loan-to-values on commercial deals is typically about 65%, maybe 70%, depending on mitigating circumstances. On the residential side of things, if it's a straight purchase, no renovations, typically about 75%.
Okay.
If there's renovations involved, which is most of the time, it's a majority of the kind of deals that we do, we look at a combined loan-to-value of 80%. So what we'll do is we'll help finance the purchase of the property and the renovations as well.
So if you are looking at a deal and it's passed muster for you guys, you make the loan, now you go out and look for the crowd, how long does it typically take for a loan to fund?
That's a great question. We've had loans, our fastest loan filled up in about 9 minutes.
Okay, that's pretty fast.
And that was about $250,000 loan.
Okay.
Our average loan size is about $375,000. But on average, our loans close out in about 24 hours. For the larger ones, it might take a little longer, maybe a week.
Well, what kind of terms are these loans? Is this long-term financing? Is it more construction financing, or is it all of the above?
It's short-term, typically 12 months, interest only, no prepay penalties. We can go out as far as 18 months. We work with our developers. If we know that the renovation is going to take a little longer, it's up in Minnesota or up in the northern regions and it's wintertime, we kind of help take that into consideration that, they might need a little extra time, so we'll give them an 18-month loan. We're not trying to restrict anybody in their deals. We're really trying to work with our borrowers in individual circumstances. So for the most part, they're 12 months, interest only, no prepay penalties.
So, Doug, let's talk geography. What kind of a range of area do you guys work in?
Yeah, we're nationwide. We're currently in 20 states. We're always looking to open up a new state. We have a high concentration in, I'd say, New Jersey, North Carolina, Florida, California. And we're, like I said, in Chicago, we do definitely like the Chicago area a lot as well, or I guess our borrowers like us there.
All right, so whether or not you're looking for a loan or you're looking to invest in part of a loan, just go to the website at patchofland.com.
Exactly.
All right, good stuff. Thanks, Doug. Appreciate it.
Thank you, Robert. Thanks for
Return to
having
the
me
Real
on.
Estate Guys radio program. More when we come back from Phoenix, Arizona. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Patrick from Paradigm Life. I've recently written an ebook called The Perpetual Wealth Strategy. The ebook discusses one of the best investments, real estate, combined with a financial vehicle used by the wealthy, many U.S. presidents, famous actors, athletes, and even Houdini himself. You can download the ebook for free in the resources section on the Real Estate Guys Radio homepage. Don't wait. Go download it now.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Creating Your Future, the 2016 Goals Retreat, taking place January 8th through 10th in beautiful San Diego, California. This unique weekend has been called phenomenal, inspirational, and life-changing by the hundreds of people that have attended. Find out more at realestateguysradio.com and click events or call 888-489-7723 extension 18. Get your life back on track physically, spiritually, and financially. Attend the 2016 Goals Retreat on the second weekend of the new year. Click events at realestateguysradio.com and register while there's still early bird pricing. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723 today.
Hey, this is Phil Collin from Def Leppard and Delta D. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. We're talking single-family houses. Hey, there's still time to join us at Creating Your Future, the 2016 Goals Retreat. It happens the second weekend of January in beautiful San Diego, California. All the details at our website at realestateguysradio.com under events. Come out and create your future. Before we get back to more great interviews, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. In just a moment, I'll give you a question that has something to do with single-family houses, and your mission will be to figure out the answer and then send it to us to trivia at realestateguysradio.com. Include your name and the answer to the question plus your mailing address so that if you're the winner, we can send you a copy of Robert Kiyosaki's latest book, Second Chance. That will be yours if you know the correct answer to our question and you're first to get it in. Last week on the Real Estate Guys, we asked this: in what country did the red poinsettia originate? The answer, Mexico. In fact, it's named after Joel Roberts Poinsett, the first U.S. ambassador to Mexico back in the early 1800s. Here's our real estate trivia question for this week. Which U.S. state has the most single-family houses? Yeah, of the 50 U.S. states, which one has the most physically constructed single-family houses? If you know or want to take a guess, simply send us your best answer to trivia at realestateguysradio.com. The first person with the right guess is going to win a copy of Robert Kiyosaki's great book, Second Chance. Which U.S. state has the greatest number of single-family houses? That's today's real estate trivia question. We're in Phoenix, Arizona at the IMN Single Family Rental Investment Forum, and it's a great pleasure to say hello to a long-term friend and fellow broadcaster. The amazing Kathy Fetke is with us. Hi, Kathy.
Hi.
It's been too long.
It has been way too long. It's so fun to see you here at this amazing conference.
Absolutely. Well, we like to say that you're one of the good gals out there educating and sharing ideas and all that kind of stuff. And now, how long have you had your radio show?
Oh, so long. It feels like I started in, I think, 2000.
Okay.
Yeah.
Yep. So been doing it quite a while.
Yeah.
And so tell us today what you see as opportunity in the marketplace and what are you sharing with your students?
Well, I'm really just excited to see that I'm right. I'm around, we're sitting here with the largest institutional investors in the world.
Yeah.
Right here at this event, and they're copying us.
Isn't that something?
Isn't that interesting? Everything that comes out of their mouth, I think you and I said first.
Yeah,
Don't
it's
you
pretty
think?
funny that
Do you
that's
think
the
they
case.
listen to us?
I'm guessing maybe so. Well, what's funny? I don't know how if you track your podcast listenership. We learned that our number one listener market is Washington, D.C. I
They
would have
are
never guessed that,
listening.
but I think maybe they are listening. So, but it is, it's validation,
Yeah.
right? So 10 years ago, a conference like this wouldn't be attended by so many suits and ties, right?
Oh,
so
of course it would be mom and pops.
It is.
Yeah.
Very interesting. The first day, one of the slides was up. So the majority of single-family homes are owned by mom and pops.
Yeah.
Right? A person owns one rental house.
Right. Yep.
There aren't that many big institutions, but there's more and more.
It's very interesting to see how they're trying to make this into an industry.
Yeah.
And they're here to stay. So, probably the biggest thing I got from this event is that they see the rental market growing, which you and I both know is happening.
Yep.
And all the reasons and the data behind that, why people are leaning towards renting or they just can't buy. Although I'm going to constantly be encouraging them to do it.
Of course,
They
yes.
should be buying. But that it's just an incredible... I thought we had the best opportunity in 2008, 2009. And I sometimes wish we could turn back the clock. But then to see these big players jumping in now...
Right.
Then you got to know it's not too late.
Right, exactly.
Which is, I remember when I first got into real estate, I would look at people who bought long ago and be a little jealous, just a little envious, like they got in at the right time. And the same thing in looking back at 2009, it's like, you could buy a house in Riverside for $65,000. Why didn't I buy $1,000? But, again, to see so much hype over what you and I and many of our listeners have been doing forever.
Right.
Is really interesting, and I'm a little fearful, tiny bit, that they're going to just completely take it over. But like you said, that can't happen.
Well, and a couple things that have happened about that, right? The first big groups that came in after the carnage and bought stuff in a lot of the markets that we have experience in, we thought that was going to be a game changer, and it was for a little while. But to me, this new crop of folks seems to be a little better funded, a little more sophisticated.
Yeah.
They're buying better. They are taking some of the things that you've been teaching for a long time and following that, where before it was just hot money chasing whatever deals, but because the pricing was low and we've had now home price appreciation, then it looks like they did well. Today it seems like you've got to still sharpen your pencil. You've got to be careful about market selection. You've certainly got to be careful about tenant screening, all the basics of our business.
Yes.
But it's going to continue to be important.
Well, and what I love about what I'm seeing here is it really, truly is turning into a viable industry where I just walk down the aisles and you've got all these companies who are wanting to profit on this new thing. So you've got these carpet companies that are offering cheaper discounts and roofing and so forth. So in some ways, I think it will become easier for the mom and pop because there'll just be better property managers out there and there'll be better screening process. And there's all this software is out there now that is helping us do our research more. And so I think for me, again, it's just really interesting to see. I feel a little old, like, back in the day, we used to just have to do all this ourselves, and it's becoming institutionalized.
Some of these one of the panels yesterday where the eldest company was touting the fact that we were formed way back in 2008, right? Like, oh, wow, since the dawn of time, right? And it's like, we had real estate before that, right?
Right.
But it has changed. We're talking to a couple people about the very nature of the single-family asset class now is different. A tenanted house is a different asset than an empty house, than owner-occupied house, right? Even though you've got multiple exit strategies, is one of the strengths of single-family. On our show, we spend a lot more time on broader economics, and we look at a lot of different stuff, and we don't spend as much time on single-family as we certainly used to.
Yeah.
This has been a really great thing for us to get our minds back into the single-family home space.
Yeah, well, I bet. Because there's some of the most brilliant minds are here, and hearing their enthusiasm. Just hearing them talk about the stuff we have been, or at least I for sure have been talking about for years, which is cash flow, and then to have them basically say the market only wants cash flow. They don't even care about the equity. There doesn't seem to be value on it. On the market. So they're just trying to build these cash flow portfolios that then they can sell, which is kind of, I know there's an appetite on Wall Street for that in anything. the software companies that, the friends I know who own software companies, they're just looking to create the membership sites and so forth. It's all about cash flow. And so, again, it's such an opportunity now to hopefully maybe even train the tenant, because as standards rise, tenants may not be able to get away with some of the things they've been doing.
Yeah,
you know,
in the age of information, more information available than ever, even the whole tenant screening process has changed.
Right.
And, I remember certainly right after the big ugliness of the crash, your tenant had no credit score. You could no longer even use it. It was no longer valid to even ask because everyone had lost a home, lost a job, lost their credit. Today, they're looking at different things, technology. I mean, just walking through the exhibit hall here, all kinds of ways to make our lives easier as investors.
Right.
So that's exciting.
Yeah.
At the same time, anytime that the big boys and girls start to get in, it does make you pause and go, I was in the right place, but can I maintain my edge?
Yeah.
Right? I mean, your listeners, our listeners, can be very nimble, right? And they can move quicker. That's the other thing about the bigger that the industry gets, the more there are chances to exploit those little unique opportunities. Some of the smaller markets that you might favor, as opposed to a larger market, and looking for where there is opportunity as the market shifts, because it changes, right?
Yeah.
Today's great market wasn't great 10 years ago.
No. I mean, that's how I got started. And that's, again, why I find this all really fascinating, because back in 2004, 2005, I was doing loans.
Yep.
And it didn't, no matter what the headline news said, no matter what the chief economist of whatever came out with, I knew something was wrong. Just none of it made sense.
Right.
And what was the book? There's no housing bubble, or that came out. David Lee Ray from NAR came out.
Yeah.
I forget what it was, but basically saying there's no housing boom, and he came out with it in 2006. So these top economists were saying one thing, but your gut, all you had to do is listen to your gut and say, why can I give someone up to $5 million a NINA loan, no income, no assets? Right. Who would do that?
Something has to be wrong.
Who sat in a boardroom in a suit going, this is a good idea.
Yeah, right.
Let's just give money away to anyone and see if they can
And of course, now we know how that turned out. So
right.
And yet it does seem like there's liquidity back in the lending side of the business again. Yeah. And we're starting to, I don't know if it's the same path or not, right? Don't have the crystal ball. But there was a period of time where you couldn't get a loan, and now there is. What's really interesting, I've discovered it here, I don't know if you've seen this, but that the lenders that are showing up that are specifically lending to investors, not any interest in lending to an owner-occupant. They're just investor lenders from 1 to 100 units. That's pretty good stuff.
Yeah, it's amazing. Kind of back then when I was seeing the problem, and we knew that that California was overinflated. I got to have Robert Kiyosaki on the show, and just like you, and had some people who had been around enough to know that something was wrong, and they weren't listening to the economists either. They were the ones that told me they were investing in Dallas. And so we rapidly urged people to sell California and exchange it for Texas. But I can't tell you, and you probably experienced this too, how many people would look down their nose at me and say, oh, nothing happens in Texas.
Right.
And I'm going, well, maybe that's a good thing, because something is about to happen here.
Yeah. Well, and all the markets that were the high run-up markets were the worst when it came to the exits, and Texas was pretty slow and steady. Yep. Today, there are Texas markets appreciating 12 and 15% a year. So is it time to be wary of Texas? I don't know. All right. So. Tell us how that we can listen to the podcast and get involved with the Real Wealth Network.
Oh, wonderful. You can look at realwealthshow.com or Real Wealth Show on iTunes. And then Real Wealth Network is how you find us. And membership is free, and we just do a lot of education on how to be a smart real estate investor.
That's what we love about you.
Yeah.
Thanks for being on the show.
Thank you so much.
There's Kathy Fedke. More when we come back. I am your host, Robert Helms. We're the Real Estate Guys.
Live nationwide. You're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Memphis is famous for being the home of the king of rock and roll, but it's also the king of cash flow. If you're looking for affordable cash flow properties, it's hard to beat Memphis. Get your portfolio rocking and more cash flowing your way by calling Terry Kerr at Mid-South Home Buyers. Terry's the king of turnkey properties. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing report. It's free. Just send your request to turnkey@realestateguysradio.com.
When the housing market crashed in 2008, San Antonio led the way in appreciation and cash flow. Would you like to have a strong, reliable investment that performs in both up and down markets? Cash flow is the key to successful investing, and we have tons of positive cash flow properties for our ATW investors. Come see why the Milken Institute rated San Antonio the #1 economy in the United States, and why San Antonio is the only major city in the country to have a AAA bond rating. ATW Investments can teach you strategies for building strong, secure wealth with investments starting at $5,000. ATW's patented, proven, and powerful system will do all the hard work for you. ATW is where the perfect market meets the perfect strategy and produces the perfect results in your portfolio. To get started, go to the resource section of the Real Estate Guys website or email us at contact@atw-investments.com.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. We're in Phoenix, Arizona this week at the Single Family Expo. This has been a pretty amazing event, and one of the greatest things for us is when we run into listeners. And let's welcome one of our long-term listeners and successful students, Sep Bakam. How are you, Sep?
Good, Robert. How are you?
I'm great. First of all, thanks for reminding us about this event. I had been to a couple of the IMN shows over the years, and I've been on their mailing list, but you reached out and said, you guys ought to consider coming to this, and this has been a great event.
Yeah, glad to hear that.
So let's talk about your story a little bit. I think when we first met, you were still active as an engineer, and you got the real estate bug. Tell us your story.
Sure. So I am a long-time listener. I've been listening to you guys since, I think it was 2010. Bought a couple properties, just 2 fourplexes, and came to the first syndication event. That was in 2011. And since then, with the tools that you guys have provided me and taught me over the years, I've been able to scale that up. So quit the rat race last year and been focusing primarily on multifamily syndication. So most of the properties were, taking what you guys taught me and putting that into real life. The challenge has been multifamily has been, the cap rates have gone down quite a bit. There's a lot more competition. Russ talks about, a lot of the even foreign capitals just wanting to be in U.S. dollars. So it's hard to find the yields that my investors are used to with that asset class. So I came across the IMN events through some mutual friends, also Real Estate Guys listeners, and focusing more on syndicating these portfolio type deals.
So let's talk about this transition that you made from investing in your own account to now going out and raising money to invest. That's a big jump for a lot of people. Take us through what that was like.
Sure. You hear a lot of the success stories where everything goes right the first time, where the properties cash flow automatically. My experience was very different. It took me 2 years to get my first, actually all the properties I had at the time to cash flow. To date, I've gone through about 10 property management companies, and I'm still a firm believer in using third-party management because all the challenges that I had with the evictions and not being able to, produce the income, it was always an owner problem. I was not having the right team managing that assets. And you guys are really big in terms of having those systems in place and treating real estate like a business and not about the properties. So along the ways, as I was able to solve those problems with having the right team that I'm thankful for, I've communicated that with my investors, and I think they actually feel more secure in being a part of that type of pool of capital for a deal, so they don't have to go make those mistakes their own. So they can leverage my experience and know that there's a good stewardship to protect their capital.
It's such a good point. People want to invest with someone who's been there and seen that, and everyone wants to think, well, you have a good track record, but the lessons you learn when things don't go well make you a better manager as things get better, right? So it's not about not making mistakes, it's about learning from the things that go wrong, which you're a great student. I know that because you keep coming back and you put into practice what you learn, which is rare but necessary to be successful. We were talking earlier today with some folks about how when the market changes, you need to correct your strategy, and you gave a great example of that, right? Multifamily makes sense for a lot of reasons, but right now where we sit, it's hard to get inventory, the cap rates are compressed, the big guys are chasing the little guys out of the room. Let's talk about the single family market. That's an interesting market. We're starting to see the opposite effect happening, where bigger money's coming into the single family space, and we've been talking about that here at this event for a couple of days. What are your takeaways, your epiphanies from what you've been learning in the last couple of days here?
Sure. In essence, the hedge funds and these REITs got into buying these thousands and thousands of properties back during the recession when, if I can phrase it, as there was blood in the streets at the time. So they were taking advantage of the opportunity, and they kind of created that space. So before, the notion, including myself, was that single family, well, you can only do 10 properties, and then from there you have to go on to you ran out of Fannie and Freddie type financing.
Right.
Now there's actually lenders that step in to fill in the void. So there's not really a cap on how many single families you can have. Yeah, in terms of thinking about the forward economy, so how if we're, say, buying a property, multifamily property at a compressed cap rate, that's a speculation. If we're expecting that same property to have that same cap rate 3 years from now, 5 years from now. So I think it's safer to be in an asset class where the rents are still inelastic, but the numbers make sense from the get-go, and you don't have as much competition in there. And it's really interesting at these panels at the conference where the REITs and these large fund managers are talking about the same concepts and ideas that you and Russ talk about on your podcast. A couple years ago, this was foreign concept to me, but with you guys, training and teaching, it kind of opened my mind to that. I can see what they're saying, and they're concerned about the same thing, slower wage growth, and they're going more for those markets where it makes sense at the get-go. So.
Yep, and it is a changing platform, right? As we see the various asset classes within real estate change, fall in and out of favor. As an investor, you got to be nimble. I think one of the big things people get stuck on is, our motto, education for effective action. You're a guy that's taken action. So what would you say to a listener out there as a word of encouragement? You've worked hard, and we've watched you really take the lessons and sharpen your pencil and study and take a lot of classes. But you've now gotten to a place where you've got a nice portfolio, things are going well. What would you say to that investor who's not there yet? I
think it's better to invest in themselves, for them to invest in their own education. Because even after I went through your guys' trainings, as I continue to do so, the properties I first started out with, I probably wouldn't have bought them with the extra tools that I have on my tool belt now. So it's powerful because then you learn that it's you're not competing for properties on the MLS. You can find those great off-market deals. You can even have those. You could set up systems in place so that those deals come to you automatically, and that you don't need to put 25% down in every deal. You can go raise that capital from investors and have the capital waiting for you over there. So I think the education is definitely necessary. Especially if you're shy like me and sales doesn't come naturally, and if you're afraid about making mistakes, I think those are definitely the people that should be in the business, because there's a lot of sharks out there, but there's definitely a need for those people that actually want to protect their investors' capital and grow that.
All right, well, good stuff. Now, we've got, of course, our syndication event coming up in January. Are we going to see you again at that one?
Absolutely.
All right, so Sep has been, I think, to virtually every syndication event we've done. It's happening January 29th and 30th in Phoenix, Arizona. Come on out. You'll have a great time. And you get to hang out with Sep as well. Appreciate your time today, man.
Thank you very much, Robert.
All right, keep doing the thing. A wonderful time here in Phoenix, Arizona, and what a great variety of folks we've had on the show today.
Yeah, it's been great. It's really interesting to see some old familiar faces. It's always great when listeners, you guys are out there in the audience. Anytime you come to a live event, please come see us, say hello.
It's our favorite thing.
It's a lot of fun because we get a chance to hear how people are responding to the stuff we're sticking out here on the radio and on the podcast and the newsletter and on the blogs and all that. So we really appreciate the feedback, good, bad, and ugly. So all of that's good. And then just as far as the conference itself, you heard that there's just a lot of different people here that are viewing this asset class from different lenses,
Right.
And there's so much opportunity because there's so much change. I think the big issue is going to be for people who just don't acknowledge that the change is happening. And we spend a lot of time on some of the macroeconomic factors. We talk about even some geopolitical factors on the show. We certainly talk about demographic factors. There's geographic factors. But add to that mix now some technological factors and some business factors. There's a whole level of sophistication coming into this industry that really didn't exist before. And when you have that, it does tighten the margins, right? You can't just be a sloppy little operator out there competing against these big, well-oiled machines that are run by corporate executives that are savvy operationally. You're going to have to compete against that, and they're going to be able to bid. I mean, we've heard a lot of the complaints over the years from the operators out there that are bidding, these hedge funds are bidding it up to where it doesn't make any sense. Well, it doesn't make any sense based on your operational cost, but they can go in and they can buy an inefficient asset and they can make it efficient. And all of a sudden, a price that didn't make sense for you can make sense for them. And if you don't adjust, if you don't take advantage of some of these innovations and tools yourself, then you're going to end up getting squeezed out of the market completely.
But here's the great news. Because those kinds of folks are in the marketplace and vendors are sprouting up to support them, the fact that there are so many different non-owner occupant lending opportunities out there today. You can borrow property now. The Fannie and Freddie stop is no longer there. Because of that, that's all happened to serve these folks, and you get to be the beneficiary of it. So if it had just been mom and pops, the lenders that are popping up today, several of which are at this conference, wouldn't be here. They're in the business to service the guy with 500 or 1,000 homes, but you get to benefit from that. Same with software, same with systems, same with buying power. A lot of the tools out there today, we get to take advantage of. And the thing the individual investor can be is a lot more nimble.
Well, I think just coming back to that debt comment, which is an important one, a lot of times as real estate investors, we only ever think about equity. That's all we think about. We think, okay, we're going to buy the property, we're going to be the owner, and we're on the equity side of things. But there are a lot of people who want to invest in the space that don't want to be the equity. Their investment is to make the loan. And so that's a great partnership. Yes, they're there to service, from an equity perspective. Of course, you're an equity guy, so you would do that. I came out of the debt side, right? And so, it's yes, you want to service, but really what you want to do is you want to get yourself in a position to get a stream of income. So, as a real estate investor, I'm going to go out there, I'm going to make a down payment, I'm going to take out a loan, I'm going to now receive a stream of income through the rental income, and then I'm going to service the mortgage. Now, the piece of this rental income stream that the lender gets is just the debt service. So I get the difference between the profit or the income on the property and the loan. And of course, that's what I'm doing is arbitraging. If I can borrow at 5 and earn at 8, then I make a 3% spread on the borrowed money, right? The point is it's a symbiotic relationship. And there are many people who want to feed on the single family home space at an institutional level. And when that happens, lots of money becomes available. And that means there's lots of opportunity for people to access those funds because the people on the debt side need you on the equity side to manage the asset because they don't want to.
All right, big thanks to IMN. You can find out what they do at imn.org. Lots of conferences in lots of places. And, of course, to all the guests today, thanks for their time and expertise. Until next week, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited that I'll be joining the Real Estate Guys for their Investor Real Estate Summit at Sea. Join me, join my friends, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there. Thank you very much.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.